Hi, good friends. So, welcome to the last section. Okay, so we're looking at IAS 37 um, provisions. Okay, we'll look at IAS 10 events after the reporting date. So, two more segments. Depending on where you are, I'm seeing a very bright weather with some blossoming flowers, good nature. Okay, so we'll wrap this up on a very good note. Okay, it's a bright, sunny situation. All right, we'll be fine. Again, once again, friends. Financial reporting is practical. That's why you will normally hear people saying it's a practice. Okay. That's why you normally hear that it's a practice. So be a practitioner. Don't wait till you get to the workplace before you practice. You can practice now in your small corner, wherever you find yourself. Okay, we'll take it just in one lap. We will not split it into two. It's more of a narrative and more of critical thinking. Then we'll wrap it up. Okay, provisions and then year-end events. I share my screen. Okay, so here we have. So first of all, we will explain an accounting standard on provision. Why is it necessary? Okay, and then we look at difference between obligations. We have the constructive and legal, and then we look at circumstances in which we can make a provision, where we can account for it and measure. And then we look at contingent liabilities, contingent assets, and then why we should disclose them. Yes. And then describe the accounting treatment and required disclosures. Okay. Look at examples there. And then we look at warranties, guarantees, onerous contract, environmental, and similar provisions. And we also look at after year-end events, um, events that occur after the year end. Okay, whether we should adjust and which situations gives rise for us to adjust, and situations which we don't need to adjust, depending on whether the amount is material. Do we disclose it or we leave it hanging? Okay, all right. So everything I've said here is what we have captured here in this graph. Okay. So I think we can move on. Let me connect this interactive pen in case I want to write. Okay, so this is the same thing as the learning okay outcomes which we have looked at on the other side. Okay. All right. So what is a provision? So provision normally occurs per the standard definition of IAS 37 paragraph 10. It's a liability. Okay, it's a liability. But under the conceptual framework, liabilities are normally measured where we're looking at some specific certain amount. But provision deals with situations where these liabilities are uncertain in terms of amount and in terms of the timing when we can incur that liability. So liability looks at the present obligation of the entity, and this arises because of a past event. Okay, and the settlement of which is expected to result in the company giving out some outflow of cash. Okay, of resources embodying economic benefits. So here they've not even limited the liability to only resources of cash, but any other resources which embody economic benefits. Sometimes you settle your liabilities with a car, with a home, with a house, with a land. These are all parts of liability. So let us not limit liabilities to only outflow of cash. Okay. Economic benefits. Accounting keeps evolving. Gone were the days where we would have limited liability to only outflow of cash. Today, it covers any resource which has an underlying economic value. Okay. So within the same provisions, IAS 37, contingent liabilities and contingent assets are mentioned. Okay. And here we recognize them one, when there is a present obligation from a past event. Okay. I hire somebody in the workplace. That's a past event. We've hired this person over the past. Then all of a sudden, this person must leave the company. It brings some kind of obligation upon us as a company, okay, to pay severance, okay, to pay some pension when this person is leaving. And again, it should be in a situation that there's a probable outflow of economic benefits, and we can measure these economic benefits reliably. The normal accounting treatment for a provision is, we are making more or less, usually making a provision to pay an expenditure. So debit the P&L with the provision that you have made, okay, and credit the provisions account. Okay, that's what we see here. At the end of the day, when you have realized that you have to pay, what do? You credit your cash and bank, okay, and then you debit your provision to reduce it or to clear it off. All right. Okay. Now, two types of obligations. Okay, you know the definition of a liability has a keyword obligation. Two types. We have the legal obligation, and this normally arises from legal jurisprudence, is where we are talking of legislative instruments or constitutional instruments, any legal instrument that gives rise for you to discharge a duty or to pay something or to emit or remit some economic elements, resources of economic value. Okay. Then we have the constructive obligation, which normally arises based on the company's own rules and regulations, their practices, their policies, their statements or standards procedures, which requires them to discharge certain responsibilities. Okay. So those are the two main types of obligation. When you look at the core text, there's more expanded um, text on it with further examples. All right. Now, how do we measure provisions? Normally, in this scenario, you should measure provisions at the best estimate of the expenditure. Okay, and be prudent enough. Try to be prudent and estimate something reasonably higher than what you would have expected. If it's a lawsuit, okay, don't work with probabilities. We are not dealing with statistics here. We look at example, you'll see the best estimate of the expenditure, which we will incur should we pay today or tomorrow in the future. Use that one as the measurement criteria. The best estimate should be one, if it's for only a single obligation, then we are looking at the most likely amount payable, the most likely, only for one single. But if we are talking of a large population of items we'll be paying, then we use the expected value. Okay, the expected value that we think we'll be paying. In effect, if you realize that this will call for adjusting for time value of money, then do so and discount it to a present value. So if I know that it is most likely I'm going to be paying 2 million in 3 years as severance, what I need to do is that the expected flow of amount will be affected by time value of money. So I will discount it to a present value, invest that amount, and aiming that I'll get that particular discount rate, the interest rate which I use to discount it to the present value. Okay, that's what we mentioned in terms of measurement. Now, there are some specific situations under IAS 37 which gives rise for us to recognize a provision. Others do not allow us to recognize or measure and report any provisions. So one, future operating losses. If I'm a company and I'm expecting that I'll make future losses, therefore I want to recognize it as a provision. No, it doesn't occur that way. So if you are looking at incurring future losses from your overall operating activities, you don't recognize provision here. It doesn't fall under IAS 37. Then we have onerous contract. Onerous contract is where you know that if I undertake this construction project, for example, the cost that I will incur will exceed the benefit that will come to me as a company. Now, under onerous contract, reasonably, if I know that the cost, I've accepted the contract, I've signed it, there's an obligation for me to work, okay, to construct some culverts or some roads, okay. But I realize that the cost will exceed the benefits. If I'm a reasonable person, I'll terminate the contract. Termination of contract comes with cost, okay. So here, provision IAS 37 is saying that we should recognize provision only at the lower of the cost of terminating the contract or the cost of fulfilling the contract, the lower. Okay, not the overall loss you are going to incur, not the overall difference between the cost, which would exceed the contract. Because at the end of the day, you want to take it up, take it. Maybe you are good for corporate social responsibility reasons, you want to take it up. Okay, but recognize provision at the lower of the cost of fulfilling the contract for CSR reasons or for economic reasons, you want to terminate it. So you recognize the provision at the lower of that. Okay. Then restructuring. If you're restructuring, usually there should be an approved detailed plan. And all employees who will be affected by this plan should be made aware. Look at the recent P&O restructuring, some form of restructuring, where 800 employees were sacked without notice. They were not made of the aware. They come to work today and security are there just working them out of the company. That is not right. Okay. Restructuring should always deal with a plan. Everybody is aware. In that case, if the obligation exists, a provision could be recognized for all the direct cost of the restructuring. So if I'm laying off 800 workers and I'm going to incur like £500,000, that's what I'll recognize. If I'll end up retraining, rehiring people, relocating staff for the ongoing business, I don't recognize provisions for that. Only the direct cost of the restructuring, not any other cost. Okay. Environmental provisions. Now, a provision should always be made for any future environmental cost, provided there is a legal obligation for you to incur that cost, or there is a constructive obligation from our policies and internal procedures. We want to incur this particular environmental cost to safeguard the system. Then you can make a provision for that. All right, good. Now, under IAS 37, it gives a definition for contingent liabilities and assets and gives us how to treat it. Okay, contingent liabilities is a possible obligation where the existence will only be confirmed by future events. These future events, we don't control it. It occurs out of the blue. Yes, even if it doesn't occur out of the blue, we have no control over it. Okay. Again, these liabilities occur, they are normally present obligations where the outflow of economic benefit is not probable. Okay, it's contingent, it's not probable. If it's contingent because something will trigger it. Okay, so we're not too sure in terms of even estimating. And again, we cannot measure these future economic benefits, outflow of economic benefit, not the inflow. We can't measure it. Okay. So the likelihood of it occurring, we are not sure. The measurement of these particular probable future economic outflows from our company, we can't measure it with much certainty. Okay. Usually, contingent liabilities are not recognized on the face of the financial statement as numbers. We disclose it as footnotes. Okay. We disclose it as footnote. Contingent assets is the opposite of contingent liabilities. So here, again, assets which will come to us and they can only be confirmed by events we as a company cannot control. Okay. And the same scenario happens over there. So we disclose it. Okay. We disclose it only if the inflow of this economic benefit is probable. Prudent concept is still playing a key role over here. Okay, it's playing a key role over here. That let's disclose it if it's probable. It's an asset. Okay, contingent liabilities, though it is not probable for us to estimate the outflow of the economic benefits, we should still disclose it. Prudence concept comes in. Okay, let's take a simple example. 3 scenarios. Shakespeare engaged in a number of lawsuits. Details are given. Number 1, Shakespeare is being sued by Malo over copyright issues, and Shakespeare has been advised he has only 20% chance of defending the case. The potential payout is 600. 20% chance that I will be successful, but it means 80% chance that I'll fail. This is a contingent liability. I will disclose it on the face of on the financial statement. Okay. Shakespeare is suing Hathaway for 200 for a breach of contract and has been advised that it has 80% chance. So this looks more like a contingent asset. Okay. So I'm going to get some 200,000, which I'll disclose. Okay. Shakespeare is being sued for 350. In fact, the scenario of the 600,000, you could even make provision for it. Okay. Now, Shakespeare is being sued for, the scenario of this, you could even make provision for it. Okay. Now, the third case, Shakespeare is being sued for 350 by Claudio for selling short measures and has been advised Claudio has a 40% chance of success. It means Shakespeare has 60% chance of going through. But again, I'll be prudent enough and estimate that I can lose, I can win 60-40 chance, but it can turn the other way around. Okay, so I'll still make a provision, a contingent liability provision of 350,000. Okay, in the books. All right. So, like I said, Malo has 80% chance. So, it's a probable outflow of economic benefits. So, we should provide for it. Now, the most likely estimate that I will incur is a 600,000. So that's what I'll recognize as provision within liabilities. Okay, in the statement of financial position. If you are not too sure of the amount, here they mention 600, so they give us the most likely. So we make provision. But if we are not too sure, we are not too sure of the probability, I recognize it as a contingent liability. All right. Then, like I said, Hathaway situation is more of a contingent asset. I have a best estimate that I win, and there's some 350,000 which comes to me. So I disclose it. Okay. And then the other way, yes, I said Shakespeare could likely win, but 40-60, just make provision, a contingent liability provision for it and disclose it in the books. Okay. Don't recognize it. Okay. All right. So that's for IAS 37. Events after year end. Events after year end. Normally, IAS 10 will define it as any event after the reporting date is the one which occurs between the reporting date and the date when we authorize the financial statements for issue. So it could occur sometimes, normally during the final audit period when the auditors are working. Okay, it can occur anything. Now, when the event provides evidence that when the events after reporting period provides evidence about the conditions at the reporting date, then we adjust the financial statement. But if it does not provide any condition at the reporting date, there are two legs. One, if it is impacting the going concern status of the company, adjust the financial statement. But if it has no effect on the going concern of the company, we do not adjust the financial statement. However, if the amount is material enough, disclose the effect in the footnotes. All right, good. Now, let's take a simple example whilst we wrap up. On 16th December, Musa approved a program of restructuring. It will lead to redundancy of a large number of staff, and 400,000 will be the direct cost of the restructuring. When they finish the restructuring, they are going to retrain staff. They are going to retrain staff at a cost of 200, and some of the remaining staff will be relocated. These are all ongoing. The 150,000 and the 200,000 relate to what's ongoing activities. Okay. However, it is the 400 which deals with the direct cost. Now, on 6th January, shortly after the year end, they announce the restructuring. They have a plan. They make all employees aware and they announce it and telling staff that you guys are going to be made redundant. The controller is not sure whether he should how he should report this in his books. So according to IAS 10, events after the reporting period, what should he do with this total 750, the 200 plus the 400 plus the 150? In reality, like I said, only the direct cost associated with the restructuring needs to be recognized. But the other ones, which are in terms of ongoing, we don't really capture them. Okay. We'll treat them as and when it appears within the reporting period. So the announcement, like I said, is a non-adjusting event because it does not provide evidence of a condition existing at the reporting date. It occurred afterwards. Okay. The announcement occurred later after the year end. Now, for us to create a provision, there should be an obligation. A legal obligation by the UK government that you need to have a plan and announce it, or a constructive obligation within the policies and structures of the organization that will need to communicate these details. Okay. Now, at 31st December, they had not communicated this scheme to employees, so no provision should have to be made because there was no obligation, no legal. Let us assume there's no legal and there's no constructive at that time. But thereafter, they then announced it. Okay. So here, as at the time that they announced it, there should be redundancy cost of the direct cost of 400,000. And this is what we need to restrict. Okay. But any other cost incurred in terms of the ongoing business, like training, relocation, we don't recognize, we don't include that. Okay, so provision would only be restricted to the redundancy costs of 400,000, which we need to adjust within our books. Okay, all right. So I end here. Please take time, chapter 15, read it, and then there are some note the table which summarizes the treatment. Very key in your core text. There are TYUs 1 to 5. Try and look at them, and we'll populate these questions with additional questions from a lecture resource I have for our tutorials. All right, friends, I bring this to a close here. Okay, and then I will see you when I see you. That's 21 minutes within, so I'm sure you'll be fine. Okay, friends, take time. Look at the other materials, other books, other core texts, and we'll be fine. Great to have all of you on board, and I'll see you when I see you. Bye for now.